Gentlemen, thank you so much for joining me for today's masterclass. Now, first and foremost, I think it's very important to define small caps. Can you give me your definition of small caps?
Sure. At Westwood, we're somewhat similar to these gentlemen. We define it as the Russell 2000 value, which is the index that we compete against. Typically, we purchase between 200 million and 2 billion, and we tend to sell when the stock hits about 4 billion.
And when we're talking about small cap investing, I think it's very helpful to get your individual approaches before we get into this masterclass. So could you give us your approach when it comes to this type of investing?
Absolutely. We're quality value managers, so we focus on the value side of the equation, but we really want to stick to the higher quality names. We look for companies that have good balance sheets, good free cash flow characteristics, good return on equity or return on invested capital. And we try to find a stock that we think is selling at a discount to its intrinsic value, which might be its future earnings stream. We don't play the deeper value names, the low price to book, price to sales. Those don't really factor into our thinking too much. We want more of the higher quality names.
And gentlemen, both of you mentioned time horizon, and I think that is very important when it comes to the small cap space. So for viewers out there who are curious about what you mean when you say long term, what is your definition?
As owners of the business, if we had it as a private company, do we like it? What do we think it's worth? Typically our horizon is somewhere between 3 and 5 years. When we do our financial projections and we do fundamental work, we go out with balance sheets, income statements, and cash flows 5 years out for every company we own. So that's really the time frame we're thinking of. If you look at the turnover of our fund, you'd say we're a 3-year time horizon. It kind of works into that. So we have an intrinsic value that we think is in every stock that we buy, and sometimes it's realized quicker in some stocks than others.
And Bill, could you tell me a little bit more about prioritizing the quantitative assessment of absolute downside risk?
Okay, that's part of our whole process. We have a 3-step process, and the first step when an analyst looks at a stock is to look at the downside in absolute terms, try to find it, make sure it's quantifiable, and make sure that it's reasonable and acceptable. So we focus on that first before we look at the upside in the stock. And quite honestly, if we can't define what the downside is quantitatively, we won't bother looking at the stock anymore. And if it's not an acceptable level, then obviously we don't look at it either, because we try to protect on the downside. And over time, we've done a good job of doing that.
Now, Bill, moving on to you, you say that you focus on quality companies. So could you tell us how they offer a long-term return premium due to the sustainable competitive advantage as well as pricing power?
Sure. We definitely focus on the quality end of the spectrum. And we think over time, the companies that have good return on equity, good return on assets, and invested capital compound that value within the stock going forward. So when we look out, we're looking at a company that is able to generate earnings growth and have an attractive return, generate free cash flow, which allows them to either reinvest in other businesses, reinvest in their own stock, or return it to shareholders through dividends. And over time, we feel that that compounds a lot of value within the stock itself as the market comes to appreciate that, which usually leads to some multiple expansion and a better price, more in line with the intrinsic value that we see in that stock going forward.
And while we're on the topic of shareholder value, Bill, I want to ask you, how do you see shareholder value being created with small caps?
Well, I think it's very similar across almost any cap size. I think the things that the companies do well in create shareholder value to the point of serving all those constituencies well, that's what a good company does over time. You can't favor necessarily one class over another. The shareholder return is the most important thing as we sit and look at the asset class. But overall, you do everything right, and the value accrues to the shareholders over time. And when you don't follow that playbook and you deviate from that, that destroys shareholder value. And I think we all did to some degree as fundamental analysts look at all those factors and factored it into our analysis. It just didn't have a fancy title or something there that you could glom onto, but it's always been part of our process. I mean, we always look at governance, especially, that's the one that stands out the most from where we sit at Westwood. But it's always been a focus of ours. It's just come into more of the mainstream now. But I think any fundamental manager has always looked at it through that lens. Just didn't know what the lens was called at the time.
And I think each and every one of you have highlighted some of the misconceptions as well as myths surrounding small caps. And since we've already jumped in, do you want to highlight any other myths out there that really get to you when it comes to small caps?
I would say just the perception out in the marketplace of the volatility in the small cap space being that much higher than the large cap space. I don't think that's a correct assumption or perception that people have. And I think if you focus on the right things in the small cap space, you have lower volatility over time and better returns.
Do you want to weigh in on this as well in terms of sectors where you're seeing opportunities?
So one thing I would go back to just a little bit, when you were talking about the business news and how it's always in your face nowadays, it seems like, and Jay was saying that's true, but you don't really hear much about our companies. That's one of the things that I think is an advantage that we have, is just there's less information, the small cap stocks are more misunderstood, and that just leads to more opportunities for us. We've been finding them broadly in the industrial space. That's the area we've been adding to, and we're overweight there. That's that and consumer staples. We found that some of the small cap consumer staples, of which there aren't really that many, have gotten somewhat cheaper, and we've been taking the opportunity to buy them. Conversely, the medical space is really hard for us. It's hard to find good companies. It's hard to find good valuations. It seems like the stocks that have good valuations are poor companies with issues, or you have all the companies in there that don't have the earnings. The other place, to your point, is the tech stocks. We've been underweight tech, and we just haven't been finding as many opportunities as we would like. We know most of them are very good businesses, but it depends on what you pay for a good business, and there's a lot we're not willing to pay up there, especially on like the software side of the business. So that's an area that we've been underweight and have been having difficulty finding new ideas.
Now, Bill, I want to go back to you. Could you tell us your experience with performance in the later stages of an economic cycle when it comes to consistency?
Typically, we've done better, and I think focusing on the quality end of the spectrum helps. When we look at the companies today, and we're probably in the later stages to some degree, how elongated that'll be is up for question, certainly. Mm-hmm. You know, when you look at the companies that have high debt loads, a third of the Russell 2000 not making money, if companies aren't making money now and they have to service debt, what are they going to do in a downturn? How are they going to survive? So I think that bodes well for our style of investment and anybody who focuses on the quality fundamentals. I think we're in a good place at this point in time.
And Bill, going back to you, can you tell me a little bit more about why an active, multifaceted approach to analyzing profitability as well as stability is so important across industries?
Well, I think because the characteristics are different across the industries. And I think when we look at them, they each have their unique characteristics. And we look at them across multiple ways. You know, we obviously look for the profitability. We do DCF analysis on all the companies. But more broadly, we just focus on individual companies and how they're doing. And that really lends itself to that approach, I guess, if I would say.
And gentlemen, I want to let you know that a lot of people in the viewing audience, they may be very experienced in the small cap space, they may not. So when they're talking to some of their clients, for the case of advisors out there, and they get questions about small caps, what do you think is the best way to approach that question in this current investment landscape?
We think active management's important, and especially in the small caps, because of the reasons we've highlighted in the passive index, that when you're buying that, you probably don't know what you're really buying as an individual investor. And then also, to Jay's point, I think we've shown value over time, and I think most successful money managers have, by protecting on the downside and participating in the upside. Whether you participate 100%, a little bit over, a little bit under, but the downside protection is what really shines through. And that's, I think, where you differentiate yourself over time.
And gentlemen, we've been able to cover a lot of ground in this masterclass discussion, but we can't deny the fact that we're in the final quarter of 2019. And if we think about the way that Q4 2018 turned out, that was clearly unexpected. So that does reiterate the fact that we don't have a crystal ball. So as we wrap up the quarter and head into 2020, there's a lot on the horizon, including, of course, the US presidential election. But staying away from that, what is your overall outlook as we close out 2019?
As far as an outlook goes, I agree with the earnings season coming up. So we own 62 stocks. Only one of them has reported so far. It's going to be volatile in the next few weeks, probably the next 3-4 weeks. But that volatility, as we've all said, we embrace, and that gives us the opportunity a lot of times to take advantage of it. Whether it's selling stocks that other people have bid up on the earnings, or vice versa, some stocks missing the earnings, and it gives us the opportunity to step into them. Maybe we've been watching them for 6 months, 2 years, and the time is there. But we don't see the economy doing badly. So I would say I'm cautiously optimistic. Of course, we're going to have down days. We're going to have drawdowns from time to time, which is healthy in the marketplace. But we see steady growth going forward, and it looks like from here, I'd say 2020 seems like a regular year where we should see normal growth. I don't know that that's going to happen. There's going to be a lot of headlines between now and then, and it's going to be probably choppier than that scenario would lead you to believe. But we don't see a recession on the horizon, and we think the market will do fairly well going forward.